Hi, welcome back to Capital Conversations. You know that in this educational series, we aim to talk about the jargon filled world of investment management and hopefully bring it to you in a way that is more understandable and approachable. Now, whether you are a newbie or whether you are into the deep weeds of technology or operations within the investment management world, we hope there's something in it for you. So, with that, stay tuned. And we once again have Amit with us to talk about nuances of performance management within an investment management world. Hi, Amit. Welcome back. Great to have you back.
Thanks,
And I think
Ashutosh.
today the topic of conversation for our viewers is performance management. And I think before we get into the sort of details of the topic, because I think a lot of our audience may not be as much conversant with the with the concept in general. Do you want to sort of establish the sort of core understanding or the premise of this conversation? What's the kind of performance management within investment management world, and what does it mean to the retail investors, or are we talking very specifically to the fund houses?
Okay, so I think just like any other field, right? You always, when somebody does something, you need to evaluate that person. Like in the corporate world, you have this whole appraisal process. In schools, you have exams,
Yes.
teachers give you grades. So I think similar in the asset management world, uh, you invest. There's a huge amount of money being invested into securities markets via funds or by investment directly. You need to understand whether the money you have invested is whether it is giving to the right set of returns or not, right?
Right.
So fund performance is nothing in case of a fund manager who is investing money on behalf of uh, their clients, investors. You need to judge the way he has performed,
Right.
whether the portfolio or the mutual fund or whatever he is managing on a client behalf has it matched the expectations of their clients and the investors.
Right, because initially when we spoke about in couple of conversations back, I think we started with the premise that this whole, I think it starts with the investment mandate. So
Right. Right. So essentially, fund performance management is nothing where you try to give what at a very basic level what is
mhm,
the absolute return a fund has returned. Say, suppose uh, it's $1 billion fund, you
yeah,
generated a 10% return, so every year you're generating $100 million.
right,
But I think the other key metric is how does that compare to some standard?
right,
You might be generating 10% return. The market in general is generating 15% return. So are you doing well?
right,
Say compared to a fixed deposit in a bank, you're doing well, but the
right,
market's still returning 15%. Why should I give money to you to
right,
manage?
right,
So fund performance is about how do you compare the return you generated on the money you are managing against the standard. In this standard, we typically will in an asset management jargon or terminology what we call as a benchmark,
right,
right? The benchmark is nothing but a representation of what we were earlier calling as a mandate.
hmm,
So in many cases, it could be very standard indices generated by stock exchanges,
right,
or it could be benchmarks created by stock indices or major industry players
hmm,
which target a specific theme. So
right,
suppose you are a fund manager with a mandate to invest into technology companies.
hmm,
So something like a Sensex is a very general index, may not fit your fund profile.
yeah,
So so the exchange or these market data providers would create a technology theme benchmark, which would be a combination of
right,
multiple technology companies, a certain ratio, which will provide a standard against which your fund would be benchmarked against.
right, right,
And similarly, all fund managers who are investing into have technology theme as a mandate would be compared. And then, as a client, even as a retail investor, I can start comparing. Okay, the benchmark IT benchmark is returning 15%. This guy is returning 10. This guy is
right,
15 or 20. Where should I invest? So
right,
at a very layman language, that is there, but there are of course further complexities as we go further. But this is
right.
how fund
Okay.
performance.
So basically, what you're saying is that if I take bunch of securities that are operating in the market, club them together under some themes, whether it's sector, whether it's some other parameter, then those are kind of are the indices. And depending upon my investment mandate, I handpick one, and I'll say I'm going to use this to measure my performance or
So
evaluate.
I won't call it handpicked. It's something generally especially in case of a mutual fund, you clearly define the benchmark and it's filed as for part of the prospectus with the regulator also, because you can't just randomly select a
Right.
benchmark. It has to be something which aligns with the objective of your mandate.
Right. So one thing is that because when I defined my mandate, we also spoke about in the risk conversation previously, and we spoke about the various nuances. So what's the interplay now when I'm picking up an index and then I have a mandate, and the third element of this is risk?
Yeah.
What's the sort of interplay?
So I think in the earlier sessions we have always discussed when the whole portfolio theory started. We started with the whole CAPM model and capital
Yes.
asset pricing model, which brought that whole risk element into it, right?
Right.
And we have always spoken of the risk and return go together.
Right.
You can't generate a very high return and assume I'm going to carry a low risk, right?
Yes.
So all of this performance, when you judge a fund manager performance, you also need to take into account the risk that he is carrying when managing that portfolio.
Right.
Right? Risk is nothing but a mathematical representation of the volatility of the returns around the average return you are getting. So a true measurement of performance is when you calculate a risk-adjusted return. So you could be, say, a fund manager A generating 20% return, other fund manager return, say, only 10% return. So you could say fund manager A is better.
Yeah.
But he could be carrying a much higher risk compared to a fund manager B. So if you do a risk-adjusted return, it could come out that fund manager B generated 10% return. It's very low volatility and something which could be very good for a medium risk kind of an investor.
Right.
And I think other key aspect of performance is what we call as attribution. Right? Attribution is nothing but a study of generating metrics which allow you to determine how a fund manager actually performed. What were the criteria? What were the basics around which he actually generated returns? A lot of times it could be just that he was lucky enough to have the right securities in a portfolio and the portfolio just grew along with the market.
So in a sense, the source of the portfolio return.
Yeah, and that is where this whole difference comes between active and passive managers, right? You're paying a higher fee to active managers who don't just simply follow the benchmark, but they do a sort of stock selection. So I think those attribution comes into the picture, which tries to point out what are the what were the key, the constituents of that return. So suppose the benchmark returned 10%, you generated 12%. What was that whole 2%? Where did it come from? Did it come from portfolio managers' stock selection, or the way he performed, or just the market just grew and he was lucky enough to have the right stocks?
Right.
So that is another in-depth research which is done to actually attribute the reasons for that outperformance or underperformance, which helps you understand how the fund managers really contributed.
Yeah.
And then based on that, those guys are then paid.
So are there like formal models to pick these attribution or the benchmarks? What's the methodology behind this? Or is it just like very subjective, or you compare? I mean, so I can imagine that I have a, let's say, index. I want to pick this as a benchmark, and then I have my risk profile. But how do I know these two are the appropriate representations of what I'm trying to do versus what I need to compare?
Okay, so there's a lot of academic research that has happened over the years, because and people and academics and professionals have come out with detailed attribution models. Say, like in an equity world, one of the most common is what we call as the Brinson's model, which came somewhere in the mid-80s, which tries to divide, especially in equity portfolios, performance into three aspects. What they call the allocation effect,
right?
Which is nothing but how a portfolio manager has done allocation of his portfolio across multiple sectors. How has that contributed to the outperformance or underperformance? The second aspect is the individual stock selection compared to the benchmark.
Right.
And third is the interaction effect, which is a combination of asset allocation and stock selection, their interaction. So, and based on these three components, you determine the overall, how does it compare to the fund performance. So again, this is one of the most commonly used models, especially in the equity world. It's been going on for almost 40 years now. But yeah, it also would have its own limitations based on the data it is available. It assumes it's a well-diversified portfolio. So all of those things are needed.
Right. So you spoke about these three sort of elements that are contributing to the portfolio's performance. But are there like limitations to these as well? I mean, you spoke about Brinson model. Are there like things that are the limiting factors of these some of these models as well?
Yeah, I think there are a lot of assumptions made with these models as with any other model. The model assumes that it's going to be a static portfolio with static weights, but as you know, there are a lot of cash flows which happen on the portfolio, which can impact how a fund manager performs. The interaction effect I spoke of is very difficult to actually interpret in a way somebody can understand. So there are limitations, but yeah, this has been a model is being used for almost 4 decades now,
Right.
and a lot of people have benefited from it.
Right.
And similarly, you have in fixed income world as well, where people have tried to attribute reasons for a fund's performance. But fixed income is much more complicated. There could be multiple elements to a model of how a performance could be attributed. Things like yield, duration, convexity. There are multiple. Those can be further broken down.
Right.
But a lot of these models have been developed over the years by various organizations. So even a Bloomberg has its own, could have a proprietary model, or a BlackRock, Aladdin, or
Right.
MSCI Bara. But yeah, almost everybody's trying to these models try to explain
Right.
how a fund performs, what are the reasons behind it, so they can
Right.
take the appropriate actions.
Right. So we are talking about performance sort of measurement here, and I think a while back you spoke about alpha and the the sort of attribution. Can you talk a little bit about what's the sort of correlation between these two, and how do I
Okay.
conceptualize
So
this?
I think alpha is more like the top level performance of a portfolio. You basically, alpha tries to measure the excess returns a portfolio earns over its benchmark in terms of risk adjusted returns. And I think attribution is more about explaining the reasons for that alpha, if I want to
Right.
bring that difference, right?
Right. So if you made 2% extra, where exactly that
Right.
2% sort of came from?
Right. So it could be like when I explained the Brinson model, say asset allocation contributed 3% to that 2% of alpha,
Right.
but stock selection actually gave a minus 1%
Yeah.
contribution. So in a sense, the fund manager's stock selection really got underperformed and contributed negatively to the portfolio's performance. Just his allocation,
Right.
allocation just worked wonders.
And what's the driver here? Because I think if so let's say my portfolio has sort of overperformed, why do I need to know the attribution? Because I'm kind of doing okay. Is this more like driven to the incentives of the portfolio manager?
I think there are multiple things to it. One is I think attribution tries and bring transparency to this whole hidden world of investment management in
Right.
terms of mathematical terminologies, which makes it easier for the investors to understand who have put in their hard-earned money into those funds, especially in the institutional world. The institutional investor try to see all of these factors. A lot of regulatory reporting requires these kind of attribution. A lot of compliance, and these reports are then also sent towards regulators and customers.
Right.
And finally, internally for asset management firms, a lot of these inputs go into how do they compensate the
Right.
fund managers and analysts. Because if the attributions say the fund managers have really not contributed to the underperformance or to the outperformance,
Yeah.
I think his compensation will change
Yes.
on that basis. Also, there are a lot of models on which fund managers are compensated. If they outperform considerably, their bonuses might be much higher.
Right.
But I think if you see from a customer's perspective, these try and bring more transparency. They want to understand, because ultimately the bonuses being paid to the fund manager
Yeah.
are coming from the customer's pocket.
Yes.
Right?
Yes.
I think so. These attribution models are evolving over.
So they're kind of in a way also a validation that things have happened because of the right decisions taken, the right
And
measures
especially in
taken.
the last few years, we have seen a big growth of passive fund management.
Yes.
Because there has been a lack of trust whether active management is really delivering what it's promised, because you're charging much higher fees.
Right.
So I think that attribution kind of tries to make those justification for those fees and the customers can actually really mathematically evaluate whether the extra fees that they're paying for active management, is it being justified?
Yeah. Okay. Interesting. I guess it looks like that brings us to like the full circle of the conversation that we initially started around the business aspects of from a business perspective. What are the key aspects of the investment management process? And I think a few months back we started by talking about the very basic layout of the components of the investment management process, and then gradually I think the way you helped dismantling all of those was just absolutely brilliant. Amit, I hope to continue doing these conversations because I think there's a lot of feedback. I think the average 8 to 10,000 people are kind of responding on these, and it's such a short period of time. And I think a lot of people are benefiting from that, from this. I think what I would like to do is to sort of maybe explore the possibility whether we can take it to like the next segment, which is kind of more driven towards aspects which may not be core business but are very tightly related to it, right? So whether it's concepts about the technology, whether these are the concepts related to the operation side of it, or anything, one thing that we haven't touched upon yet, and I know you have great expertise there, is the kind of what goes on in the background, the sort of back office processes, and how do you calculate the nav, all that kind of stuff, the technicalities that sit behind it. So hopefully we'll come back in a couple of weeks, organize something around that. And for all the viewers, please stay tuned and look forward to see you again soon. Thank you,
Yeah,
Amit.
thanks, Ashwin. I've also enjoyed these conversations a lot.
Thank you. Thank you.